Hello class, my name is Mr. Makoli and I want us to look at the topic that we are handling, that is financial statements of a sole trader. Today I want us to have a video class and see how we are supposed to do it practically. I want to share what we already have in your dashboard about the format of the financial statements of a sole trader. Remember, the sole trader, we said it's a person who actually manages the business him or herself, and at the end of the financial year, he enjoys the profit and losses alone. And we said the format of these statements, if we can start with the income statement, you will find that we have the sales, then you less the return inwards, or the sales returns, so that now if you subtract these two figures, you are supposed to get the net sales. Then you less the cost of sales, whereby you are supposed to have the opening stock. You add purchases. To the purchases, we normally add the carriage inwards, and then we less return outwards, so that we can get the cost of goods available for sale. After getting the cost of goods available for sale, you less the closing stock, so that now you can get the cost of sales. The cost of sales you minus from the net sales, so that you can get the gross profit. The gross profit, then you add the discount received, rent received, interest received, and other incomes, so that you can get now all the incomes. Then you less all the expenses for that particular period, so that you can arrive at the net profit. There's an illustration that is here. The trial balance is given with the figures, and then you are asked to prepare the income statement or the trading profit and loss account. This is how we do it. The sales from the trial balance was amounting to this. You less the sales returns, or the goods that were sold but they were returned back later, so that now this figure is what we call the net sales. From the net sales, now you less the cost of sales, which comprises of the opening stock, which is normally indicated in the middle column. Then you add purchases. Purchases, remember, anytime you look at purchases, consider whether you have got carriage inwards and return outward. If they are there, then you need to utilize the first column here. Add purchases here, add carriage inwards. Remember, carriage inwards is the transportation expenditure for those particular purchases, so that you can get actually the total amount that you have spent in purchasing them. Then you return, or you less the returns, or the items that you returned back to the supplier, so that now you can get this figure. This figure is now the net purchases. You add to the opening what you started with plus what you had purchased will give you the cost of goods which are available for sale. And then you less the items which are not yet sold at the end of the year, and then it will give you, this is what we call the cost of sales. Remember, by doing all this, we want to arrive at this particular figure. The opening stock is put aside, then you adjust the figure for the purchases accordingly, and then you less the closing stock, so that now you can get the cost of sales. Remember now, that simply means this sales that we received, this amount that we received from sales, it had costed us this much. So we spent this so that we can receive this. The difference between the two now becomes the gross profit, which is actually this figure. From the gross profit, you need to find out whether there is what we call the non-trading income, whether there is a discount received, rent received, commission received, and all that. If there is none, you less all the expenses for that particular year. You less them here. First of all, you add them, all of them here, then you less the total here, so that now you can get the net profit for that particular financial year. There's another example that is illustrated here with end year adjustments. Sometimes when the year comes to an end, some expenses have not been paid, some income has not been received. That calls for end year adjustments. And we normally use the accrual concept, as we have always done, to determine or to do that particular question. Like for example, in that trial balance, that is, these are the figures. But now you are told here that By the end of this year, there was this stock. Actually, this is simply the closing stock. Then you are told that depreciation on fixtures and fittings and the motor vehicles is to be provided at 5% and 10% per annum on cost respectively. And here it is a case of an adjustment. And remember, when it is on cost, we use the cost. But if it is on reducing balance, we must rest the depreciation for the previous year. The rates prepaid for that year was this. Prepaid, remember, we have paid in excess, and this amount will be utilized the next financial year. It was paid in excess this financial year, but it will be utilized the next financial year. So what we need to do, from the rates that we have paid, we rest this amount. The unexpired, remember, is the same as the prepaid, where insurance was also affected. Higher. Let us now see what will happen. We are supposed to prepare the income statement. Remember, the income statement is also known as the trading profit and loss account, and we are also supposed to prepare the balance sheet. The balance sheet is also known as the statement for financial position. Anytime you are given a question like this, and which is very common, always start with the workings. Do the adjustments to the additional information. First, start with the provision for bad debts, and you are told it is 2.5 of the debtors. If you calculate 2.5 of the debtors, you get this figure. Once you get that figure, and at the start of the year, they were 50,000, and it's this, then you need to do an adjustment and get that this figure now, 4790, is an increase and should be considered as an expense. Should be considered as an expense at the end of the financial year. Then provision for depreciation, you calculate accordingly. Fixtures and fittings, they were 5% of the cost, which gives you this. Motor vehicle, it was 10%, which gives you that. The prepayments, always we add them. Always we add them because they have not been earned. This is now the case. You get that figure, and then now you can go ahead and prepare it. I don't want to spend time on this statement of the income statement because I've demonstrated that. My interest is here. How do we prepare the balance sheet? You must have 3 columns for the cost, accumulated depreciation, and the net book value. You less the depreciation here from the cost so that you can get the net book value, and the interest is actually on the net book value. Then you consider the current assets. You also record them appropriately. You find it is here. Then this figure plus now the figure for the net book value for the fixed assets will give you the total assets that are there. And then from that particular case, you less the liabilities and the capital so that now you can be able to balance it. Thank you very much.